Welcome to the Daily Update, where I'll go over the action in the market for Thursday, July 19th, and then we'll see how things look for Thursday, July 20th. We had another up day. The market seems to be caught in this FOMO, the fear of missing out. It wasn't a really strong day. We're starting to see a few more cracks of weakness, and there's also a convergence of some signals that, when taken together, could suggest that we should see a pullback at some point. Now we just need a trigger for that to happen. Right now, it looks like it would just be a short-term pullback. Of course, if we do start to fall, we'll reevaluate things and see if they turn more negative. But overall, the market still has a healthy backdrop, and even a bit of a decline from here would not necessarily be a surprise, nor necessarily put in danger this momentum that we've been seeing lately. But we still want to have respect for the market and reevaluate things as they develop. Let's go back and talk about what happened. Right at the open, we had a higher open. This was kind of the first clue to me. We actually gapped higher at the open. Monday and Tuesday, we had a higher open, but it wasn't really a gap. And a lot of times that means there's pent-up enthusiasm through the night. These are usually people that don't follow the market all the time. They're saying, whoa, the market keeps going up. They log onto their computer, enter a buy order to be executed at the open. And so you have this tidal wave of orders coming in. When there's a lot of buy orders at the same time, quite often that'll be a reason why we get a gap higher. Now, there's other things that play into it, whether we gap higher or lower, but that is one of the things that we're seeing as people are going, wait a minute, I thought the market was going to be going down. Sell in May and go away. Now it's going up. We're hitting 52-week highs. We're hitting all-time highs in certain areas. I better jump back in. And that's kind of the prevailing attitude that a lot of folks have. And that often signals that, okay, these folks need to be proven wrong. Don't be surprised if we start to see some kind of a downward move. Is it going to develop into a full-blown negative decline? We don't know that yet. Right now, we're just seeing some things coming together. But at the open on Wednesday, prices climbed immediately up to R1 at 45.73. As the day went on, we chopped above and below R1. We fell almost back to the unchanged level. Then some late day buying came in and took prices back up to R1. We ended up closing just below R1. We were up 0.24% on above average volume. That's been another thing that's been picking up lately. The technicals are positive. We do have this positive backdrop, but we are very overbought. Folks are getting a little bit too complacent, thinking that the market is magically going to always go up. And that often signals, okay, these folks need to be dealt a dose of reality. Inflation and interest rates are still what the real focus is, and so far, looking out into the future, growth concerns seem positive. What are some comments that we can make? Is there a convergence of negative signals leading to, right now, what appears at some point could be a short-term pullback? Short covering and the fear of missing out, or FOMO, have been preventing the markets from falling. Anytime this buy the dip mentality, or BTFD, buy the friendly dip, that's what's been happening, and folks are getting back more into that mode. I'm not a big fan of that mode because that can work 5, 6, 7, 8 times in a row, and then the last time you kind of take it for granted, that's when everybody gets wiped out. The S&P did make another 52-week high. Of course, anytime we go up after we've made a 52-week high is going to be a new one. The positive scenario is still in the background, that we're going to have a soft landing. That means an economic slowdown that we've already been seeing without necessarily going into a recession. The idea that the Fed may almost be done raising interest rates, and that, looking out into the future, earnings growth still looks positive. On a short-term basis, we still have a very long list suggesting that we're overbought. The moving average study, the CMB composite, the CCI 14 and 20, the Stochh RSI, the Williams percent R, standard deviation, stochastics, the boom indicator based on 20 periods as well as 9 periods for the RSI, intermediate term, the balance of power, the Arun indicator, the rate of change going back 50 periods, the PMO studies, oscillators, which they're working off a lot of this negative divergence, but we're seeing a negative divergence in another area that I have a chart to show you that is giving us a little bit of concern, and that's what the NASDAQ 100, the Sean Trend Meter, the BPI, both for the S&P 500 as well as the NASDAQ 100. The percent B is coming back down, but it's still pretty high. the boom indicator based on 50 periods, and the RSI based on 14 periods. On a long-term basis, some of our long-term moving averages are starting to get extreme positive. The dollar was up and interest rates were down, and all of the yield curves that we watch still remain inverted. None of them have switched back yet. Sentiment continues to be extreme at 82, where it had been at 82. Our trend is positive. The green line's going up, so we default to the positive. We don't know when this pullback is going to occur, so we just go with what we see right now. The ADX continues to strengthen. It's above its moving average, and both of them are above 20. Our bias continues to be positive, and our momentum is positive. The economic reports that came out, we had the weekly MBA mortgage applications index. It was up 1.1%. Last time it was up 0.9%. When you look at refinancing applications, they were up 7%, where purchase applications were down 1%. Total housing starts down 8% on a month-over-month basis. When you take that out annually, that's 1.434 million, less than the 1.475 million they had expected. Building permits also declined, down 3.7% month-over-month. When you take that to an annual rate, that's 1.440 million, less than the 1.472 million they had expected. This is the chart that we get every week of the mortgage applications, where we are a little bit above zero and advancing, but not showing any real strength. Here are the housing starts and building permits with a 3-month average. The blue line are the housing starts, and they're starting to come back up. The yellow line are building permits. Even though they declined on a year-over-year basis, they are continuing to go up. Here is the housing starts on a month-over-month basis, showing how we did decline from the previous month. Looking at some isabelnet.com blog charts. This is a chart we look at about once a month, showing the truck tonnage index. That's the gold line here, where it is showing some improvement. The purple line is the S&P 500. There's still a wide spread between the two, but we are seeing the gold line starting to turn back up, which could suggest some more strength coming back into the economy. Also, stocks tend to do well after midterm elections. Well, we've dealt with that many times. The average is being up 14.1% overall. Then looking at the cash levels, they're starting to go up a little bit. They're at 5.3%, where they had been at 5.1%. The macro and the markets, where we look at those that are expecting a stronger economy, that's the dark blue line. It's improving a little bit, but still negative. And then we compare that to the S&P 500, which has also been showing a lot of improvement. Then what are the sector flows right now? Money going into tech, money coming out of energy. The equity allocation, it's now at 61%. It did decline just a little bit, but continues to be above average. Folks are now starting to favor the idea of having a soft landing. We're currently at 68%, where it has risen to that level. There's 21% suggesting that we will have a hard landing, and there's still 4% that thinks we're still going to float around and never land. Looking at this is showing that sentiment is not improving into the second half. It still remains bearish. I beg to differ with this a little bit. It had become quite extreme negative, but it is showing some improvement overall. This looks at some different measurements where we look at other sentiment indications, and we're seeing some real exuberance in that area. In the past, real retail sales trended sideways before a recession began. Could you suggest that we are trending sideways here? You could. So this is one of the cases that we might go into a recession. When we look at GAAP earnings versus the PPI-CPI spread, the black line are the GAAP earnings down here where they continue to decline. We're also seeing a real discrepancy here with the PPI to CPI spread, where it's really been declining. Looking at our charts and analysis, intraday, where we had a gap higher up to R1, that was kind of a warning sign. If you look back on Monday, we just had a little bit of higher open. Tuesday, a little bit higher open. Well, we gapped up. That means folks are getting a little too exuberant. At least that's how I'm reading this. We chopped along R1 for quite a while. We almost came back down to the unchanged level. We saw some late day buying and then a little bit of selling going into the close. Intraday, we were pretty much flat in the initial overnight session, showed a little bit of improvement in the pre-market session. Then it was during the cash session where we really saw the strength, and then we're trailing off a bit going into the initial overnight session for Thursday. Large cap growth and value. We're showing where growth is underperforming value. And it did underperform with the large caps where they were all up, but growth was up less than value for the large caps as well as the mid caps and the small caps. Our intraday chart also shows that growth underperformed value. Here's the dashed line, meaning that we were negative and there was some selling going into strength as the market was going higher. Sentiment still suggests that there's not a lot of fear. That's also been another warning sign that we've been watching for quite a while. The VIX ticked up just a little bit. Again, the VIX being up on an up day is kind of strange, both on the line chart as well as the bar chart. Volatility still tends to not be moving all that much, even though it ticked up just slightly. This is another warning sign that we've been watching. We're coming back down after getting an extreme reading with our VIX to S&P 500 correlation. This continues to fall, but we're worried about this spike right here. And if you look at other times when this happened, sometimes this meant positive things for the market, but a lot of times it also meant a short-term pullback. Another warning sign is the equity put call ratio. What we focus on right here is this 0.8 line. When we get above that, that usually signals that we're at or near a bottom. We've been really dropping with the equity put call ratio, and we're dropping down below 0.55. Other times when that has happened, that has also often marked a short-term top in the markets. Doesn't mean it's going to play out immediately. We're just getting set up for something like this to possibly happen. But longer term, we still remain positive as the equity put call ratio continues to decline. We're looking at the MOVE index. Bonds were up, so we saw volatility drop off. Stocks were up, but we saw the VIX turn up just a little bit, but the correlation between the two remains pretty strong. We're seeing a decrease in this fear chart that we follow, and we're also seeing a continued decrease in this other fear chart. There's just not a lot of fear out there right now, and at some point that can come back to bite people. On a more positive side, we are seeing a continuation of the high beta stocks outperforming the S&P equal weight ratio, which is suggesting more of a risk-on type of environment. The advanced decline line studies, we saw some improvement here. We're showing improvement based on price and volume, so that's positive. New highs, new lows, we're still seeing new highs outweighing new lows, but we continue to go flat with our 5 period. However, we're advancing slightly with the 10 period. The advanced decline ratio did tick up and is above 0. That's positive. Accumulation distribution showed a little bit of a decrease, but we're still above the advancing moving average. We saw some improvement with the cumulative advanced decline line of the NYSE on the top, and we're seeing the NYSE advanced decline line showing improvement and breaking above these previous highs. We're also above this upward sloping trend line when we look at a different version of the advanced decline line for the NYSE. We're seeing a little bit of improvement with common stock based on price. We're breaking out above this previous high, but we continue to lag based on volume, even though there was some improvement in this chart. All of our advanced decline line studies are showing continued strength. Our trend in volume. This is another warning sign. We're still extreme positive with the green line. This is suggesting that we're in a strong trend because the ADX is above its moving average, but it continues to get up closer to that 40 level. It's even more pronounced in this other chart where in our short-term ADX study, we are already above 40. The green line is also above 40. This could really suggest that we are overbought. Volume has been picking up slightly. Looking at the daily chart, we are coming up to the underside of this upward sloping trend line. Is that going to pose some kind of a problem? Will this be a trigger for some kind of a short-term pullback? On the bottom, you can see we've now had 2 days in a row where volume was above average. We're still looking good with our double and triple exponential moving averages. That's looking healthy. The 20-period exponential moving average is now getting extreme positive. Also with the 50, we're looking better with the 200-day exponential moving average. The Stochk RSI is still pegged at the top, extreme positive. The Williams percent R ticked down a little bit, but is still extreme positive. The CCI 14 is extreme, and the CCI 20 is extreme. The stochastics are extreme positive across the board in the short, intermediate, and long term. The force index continues to be positive. Now, looking at some intermediate term charts, the balance of power is coming down, but still extreme positive. The CMB composite just is going up, and at other levels, this often marks some kind of a short-term top in the market. The boom indicator continues to be extreme positive with the 20 and 50 showing improvement with the 200 period moving average. Looking at our double and triple exponential moving averages based on 50 periods, this is still holding up and looking positive. However, look at the bar itself. To open, go up high, and then close down near the open, that's not a really good looking bar. And we'll see that on other charts. However, the go-no-go system remains positive. We're still at the highest high level, suggesting that there has been good momentum to the upside. The TTM squeeze continues to show improvement. We're above the third standard deviation now. And again, this bar looks kind of scary. And this chart also suggests that we've gone up pretty far, pretty fast. The rate of change going back 50 periods did decline a little bit, but is still extreme positive. The ease of movement continues to show more positive action. The PPO studies are still positive. The Erin indicator is still extreme positive. The green line is pegged at the top. The red line is pegged at the bottom. Our oscillator measures the difference between the two, and we are extreme. The S&P 500 McClellan oscillator is showing improvement. It turned back up and is above zero. So the summation index based on price continues to improve. We're looking better based on volume, but we are lagging a bit, so that's a bit of a negative divergence. The NYSE McClellan oscillator is above zero and advancing. The NYSE summation index based on price and volume continues to show improvement. The Swenlin trading oscillator, we've seen this 2 days in a row now. We've had up days, but yet based on price and volume, this indicator continues to decline, even though it's still positive because they are both above zero. The PMO is showing good momentum. We're also climbing based on price and volume. With our PMO study, we're turning up just a little bit with the percent of PMOs that are rising. We're flat with the buy signals, and we're starting to get a little more extreme with the PMOs that are above zero. The Elder Impulse system for the S&P remains positive. The parabolic SAR remains positive. The slope is also positive, and the MACD is positive. All of our oscillators are showing some improvement, but we still have this negative divergence in the background with our short and intermediate term indicators. We're pretty much flat with the longer term oscillators with the TRIX and the KST. The Sean trend meter continues to be extreme positive. And the bullish percent index, although it's showing good momentum, we're starting to get to an extreme reading. The NYSE bullish percent index is not extreme, but showing improvement. The Chaikin money flow also seeing some good buying coming in from the smart money. The Chaikin oscillator actually ticked down just a little bit, but is still positive. The money flow is pretty much flat and not extreme yet, but continues to be positive. The ultimate oscillator ticked down just a little bit, but is still positive. The vortex, the green line continues to advance. That is positive. On balance volume continues to be positive. The relative strength index for the S&P 500, we are still dealing with this negative divergence, but now both the 14 and the 9 period have become extreme positive. We're seeing a little bit of improvement with our 200-day moving average study for the S&P as well as the 50 period moving average study. And here's another representation of that same chart using a histogram. The Kopik curve continues to generate a buy signal. I don't have any Fibonacci and line studies to show you now because we continue to be in no man's land. Our charts, the Heikin Ashi is still positive. The Kegi chart is positive. The Renko chart is positive, and the 3-line break chart is positive. Our different indexes, the equal weight, it's doing a little bit better and had a good day, but continues to underperform the S&P. The ratio is also starting to go back up, but the big stocks had really been outperforming the smaller stocks. This is also looking pretty good. With Dow theory on the top, we're continuing to break out on the Dow. We're continuing to show some improvement with the transports. We saw a little bit of a turn up with the utilities. Then looking at the ratio between the transports and the S&P, it continues to go up, but it's not really going up all that strong. The relationship between the S&P and the transports continues to show some improvement. And the Dow and the transports are just about even with how they're performing. The discretionary equal weight versus the staples equal weight, we were down a little bit with discretionary, up a little bit with staples, so our ratio declined a little bit, but overall discretionary is outperforming staples. The Dow was not able to close above this R1 level. That's another little warning sign. But the diamonds still remain positive, but look at this bar where we had the open and then we went up and then closed right at the low. That's a little scary looking bar at times. The NASDAQ also is having trouble. It came up to R2 and then was not able to close above that. The cumulative new highs, new lows for the NASDAQ continued to show a little bit of improvement. Our indicator down below is positive, but overall we continue to see a decline. The NASDAQ 100 also having trouble getting through this R2 level. It was not able to break above that. The Elder Impulse system for the Qs, though, remains positive. And then the NASDAQ 100 bullish percent index continues to go up and is giving us a really high reading. If this starts to roll over and come down, that could be a sell signal. Then here's the new chart where I usually don't show this. This is the NASDAQ 100 with the PPO on the bottom, where we continue to see a negative divergence here. The premise that I'm looking at right now, and you can take this or leave this, that's all up to you, is it's the NASDAQ 100 that led us higher. If it starts to run into trouble, is that going to be the one that takes us lower in the S&P? Just something to be aware of, just a scenario that I've developed. Then looking at the Qs, they continue to outperform the Dow overall, even though they declined slightly. The small caps continue to show some strength. They were up over 0.5% and broke above this R1 level. We're still above the support/resistance level, but we're coming up to this other resistance level. If we hit that, is that going to pose a problem for the small caps? We're looking extreme with the RSI, but we continue to be positive with the MACD. The Elder Impulse system for the small caps continues to be positive with a green bar. Small caps are improving a little bit, but continue to underperform the S&P 500. Small cap growth versus value, we are seeing a bit of a decline as it's going more or less sideways, but it's still in an overall uptrend. The mid caps were able to stay above this R1 level, and this is where more of the strength in the market has been coming from. The Elder Impulse system for the mid caps remains positive, and even though we decline with the ratio, we're still in an overall uptrend when we compare mid cap growth to mid cap value. The dollar is trying to come back above 100, but has not quite been able to do so. The FANG index is still above the all-time high, setting new all-time highs. It was actually down a little bit in Wednesday's session. If we fall, will this provide support, or are we going to fall down even more? However, when you look at the S&P with 3 to 7 year bonds, it continues to show that the market thinks we will get a soft landing. When we look at a broad market index of the S&P 1500 and compare it to shorter term bonds, it also suggests that stocks are outperforming bonds. And I haven't shown this in a while. The Qs have really been outperforming bonds as well. And so everything is still looking positive. That's why if we do get some kind of a pullback, initially we just have to think of this as profit taking, or that the market had gone up too far too fast and we're just seeing a decline for those reasons. If that continues to gain some momentum, then we will switch our stance. The broad market, looking at bonds, also continues to show that stocks outperform bonds. The tech sector is also outperforming bonds. Home construction is a little bit sideways here, but has really been outperforming bonds. Remember, this is a highly interest rate sensitive part of the market. Growth continues to outperform value, even though it ticked down slightly. Here's the bank ETF showing some strength here, up another 2.74% in Wednesday's session. The financial sector is showing some improvement, but not enough yet to give us a golden cross. The financial sector continues to show some improvement when compared to the S&P, but is still in a downtrend. And the regional banking ETF had a good day, but is still in a downtrend when compared to the financial sector. Bonds, we saw a bit of a decrease based on yield and a bit of an increase based on price, enough to get back above the 50-period moving average. The RSI is going higher and the MACD is positive as well. Here's a chart that I haven't shown in a while. Growth to value ratio, comparing it to the 10-year yield. They are showing some improvement where they're having a tendency to go more in the same overall direction. We're also looking at the Qs to longer term bonds, showing that they're still going in opposite directions, but they're having more of a tendency to go in the same direction. That seems to be improving. We're still seeing a decline when we look at riskier bonds versus more conservative bonds. We're still going up overall, but folks might be getting a little bit antsy and want to switch over to more conservative bonds. We're also keeping an eye on the S&P 500 to the long-term bond ETF. This is showing some improvement with our longer-term relationship and our shorter-term relationship, but the spread continues to be quite wide. We're also seeing a decline here when we look at cash versus the 3-month bond ETF. We want to see this going down if we have more confidence about the fate of interest rates. This is still in an uptrend overall, but has been showing some recent weakness. We're still above the level set on the 3-month yield that we hit back in 2007. And then our long-term charts. The special K daily chart continues to be positive. Please be aware the weekly chart is still negative. We're looking pretty extreme with our 150 and 200-day moving average study. The rate of change going back 200 periods is continuing to show more long-term strength. Then we're also slightly above this longer-term resistance level when we look at the weekly chart of the S&P. Are we going to be able to stay above that? If we see some weakness, will we fall back down below that? Also with the NASDAQ 100, we're still above this resistance level. The same thing. Are we going to be able to stay above it, or are we going to end up falling down below it? When we look at the ratio between the NASDAQ 100 and the Dow, we're still continuing to get quite high here. Other times we hit these high levels was not good for the market. An update of our possible positive scenarios. The Qs continue to outperform the S&P even though they ticked down slightly. The same with discretionary versus the S&P. And large cap growth did turn down a little bit when compared to large cap value, but it's still outperforming overall. With our growth to value ratios, a little bit of a decline with the large caps, mid caps, and small caps. The S&P to utilities ratio continues to go up, which often gives good support to the S&P. When we look at the broad range of the Amex, the NASDAQ, and NYSE and take a 5-period moving average of their highs minus the lows, we remain positive. The 10-day average of the S&P 500 highs minus the lows continues to hold up in this extreme positive area, showing that there is good momentum. If we start to fall, we'll see how quickly that falls if we get some kind of a pullback. When we look at the 50-period exponential moving average of the new highs minus the new lows, we continue to be positive, and the moving average continues to advance. Then on the longer-term chart, we also see where the red line is continuing to go up. This is another concern. S&P growth has been underperforming S&P value lately, even though it's still in an overall uptrend. We have been trailing off with this ratio. The 2-year Treasury yield, not really knowing if we're getting any kind of a signal now. What we want to see is, does the 2-year yield spike and then start to come down? Sometimes that gives good support to the S&P, but we're not really seeing that yet. But the Staples to S&P 500 ratio, even though it ticked up slightly, continues to decline, which also gives good support to the S&P. So what's our outlook for Thursday? The technicals are positive, but we are overbought. We will be getting the weekly jobless claims, the Philadelphia Fed survey, existing home sales, and the leading indicators. Please be reminded that on Friday there won't be any economic reports to be released. We're keeping an eye on all the geopolitical events, but the market is still fixated on inflation and interest rates. Here's the updated version of the economic calendar. Then, looking at the Stock Traders Almanac statistics, I meant to highlight this earlier. During options expiration week, going back to 1980, we're up 57.1% of the time and down 42.9% of the time. The week after, we're split 50-50 between the two. For July 20th, we're pretty positive across the board, with the Dow, S&P, and NASDAQ all looking more positive. We will be on the 13th trading day of the month. Please remember that Friday will be options expiration. We can sometimes see some weakness during a pre-election year when that happens. We're also coming up into the middle part of July for the NASDAQ, where sometimes historically we have seen some weakness. So our scenarios, can't go with the down one yet, other than just some warning signs being out there and the fact that we're overbought. We're not seeing any follow-through based on price. So we still default to the positive trend until proven otherwise, and we're not going with the sideways trend right now because we're still in a strong trending environment. Our warning signs, are we seeing a convergence of short-term bearish signals? This can be the S&P to VIX ratio that has now fallen, the 5-period simple moving average of the equity put call ratio dropping below 0.55, the negative divergences that we're seeing on our charts, but we're really seeing that more in the NASDAQ 100. And we are coming into a seasonally weak period of time for the month. The longer-term trend signals may be signaling a top, but so far that hasn't happened. We keep going up. We are in a seasonally and historically weak time of the month. Our oscillators are showing negative divergence, but they are improving. unless you look at the NASDAQ 100. The VIX is showing a lot of complacency. It's acting weird. That's why we've been watching the S&P to VIX ratio chart. The cumulative new highs, new lows continue to show weakness, even though they ticked up a bit. The 3-month yield is above where it was back in 2007, right before the great financial crisis. The S&P 500 growth is still positive, but it is showing some weakness, and then earnings will be released and can be either positive or negative. Longer term, we still have seasonality and setups that remain in the background that give us a positive stance longer term. The daily chart for the special K is positive, but the weekly chart is negative. The equity put call ratio is positive because it's declining. That gives support to the market. The S&P is still above that downtrend channel upper line. We're still far away from that. The market is still favoring a risk-on posture. Lower price levels may provide support. Those might come into play at some point in the near future, but so far, we can say that support has held. The S&P is outperforming utilities, which is positive. The NASDAQ and NASDAQ 100, they are breaking out, but they're running into some problems with these pivot levels, but they are above that longer-term overhead resistance. The Staples to S&P 500 ratio is declining, which is positive. The small caps, based on the Russell and the mid caps, have generated recent golden crosses. We're getting close, but we're not quite there yet with the S&P small cap index. Small and mid cap growth continues to be positive, and the Copic curve has generated a recent buy signal. So our conclusion, the S&P remains positive but is overbought. Short term and intermediate term, we're positive but overbought. Long term, we still continue to be positive. Thank you. I hope you found this helpful. I hope you have a really good day, and I will talk to you in the next video.